Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Welcome to the Friday, November 5, 2021 Market Plus. Ladies and gentlemen, Ted Seifried is back. And Ted and I talk quite often and before we tape, so forgive us if it sounds like we just forgot the cameras are rolling. So a couple things. I have my phone. I'm going to read a question that came. You all were great with questions this week, as you always are, and always appreciate it. Look for that tease Wednesday, Thursday to say who's coming on the show. Answer us with what's on your mind, because frankly, everything's different. So Ted, the first thing, though, I need to get to is what was teased during the broadcast, and that was some exact numbers. The industry estimates came out yesterday, Thursday. Yep. Zaner your company has estimates.
Yep.
We have a big report on Tuesday. We have a question about the report. Where are you seeing us? Wanna go the big 3?
Yeah, so the average trade guesses, to me, are very similar to a lot of Zaner's guesses, which I always find interesting. But, you know, the trade's looking for 0.4 increase in yield for both corn and soybeans. That would put the USDA's yield at 176.9. Zaner's at 177, and for beans that puts it at 51.9. I'm at 52.4. I think that bean yield number could come in quite a bit higher based on everything that I'm hearing going through harvest. Everybody's, especially in the really bad areas, have been really shocked with the bean yields that they've been getting. I'm really worried my numbers might be even too low. So we'll see. Maybe not on this report. I really do feel like the USDA is going to have to raise production for both beans and corn. I'm just not 100% sure that they're going to do it on this November report. That might be something that comes in January. But I think those yield numbers are higher. And then as far as ending stocks are concerned, the trade's got corn coming down by 20 million bushels to a 1.480 billion bushel carryover. I'm a little higher. I'm at 1.544, so I think this could be a little bit of a bearish report for corn. But even at a 1.544 billion bushel carryover, it's still tight enough that we can have a bullish story in an inflationary climate, in a climate where ethanol is really rocking and rolling. If we get any sort of extra export sales, we should at least be on our toes for that Brazilian corn crop. And then for beans, the trade is looking for a pretty healthy increase in soybean carryover at a 362. We're at 364. But again, I'm worried that yield number might come in higher than everybody's expecting, and that could be bearish too.
Okay.
Yeah.
Like I said, great questions always came in. But this one came in a little bit later, and Ted really wanted to address it. Steve asked on Twitter, Ted, you were so right about what you've been saying for months about soybeans. I should have pre-read these because I was clearly playing them up. That's the price.
Checks in the mail.
I knew exactly what you were doing. You were so right about what you've been saying for months about soybeans, that the price would have to come down to attract export demand. Outstanding. So how far down and for how far long do you think is needed?
Yeah. So the price that I've been talking about for quite some time in order to find that demand is 1080. That's not a number that a lot of people want to hear. But honestly, I think that'd be really good for the market because I do think that the big global importers, i.e. China, would get very interested at 1080 soybeans. And if China were to come in and buy an extra 5 to 10 million metric tons that we weren't expecting, oh boy, all of a sudden we are in the same narrative, in the same story that we were this time last year. Oh boy, we could run out of soybeans again. So if we want that bull market, we need to see those lower prices to find that demand. And if we find that demand down there, this soybean story could be right as rain once again. There are other things that could happen, you know, South American weather problems and things like that. But if that South American weather problem doesn't happen, yeah, I think we need to find that demand.
So it's like a storm before we get to smooth sailing a little bit if it goes down the way. Okay, another thing I want to ask is a little different. When you drive for several hours in the car, there's always something on your mind, and sometimes I don't always get what's on the analyst's mind. Ted, what was on your mind on the drive today that you wanted to say to this audience?
Okay. So the first thing that was on my mind, Paul, was holy cow, E85 conversion on a 650 horsepower car and an extra 73
You were setting me up for a car comment all this time?
Sorry. It sounds amazing, and it's so fast. But, you know, it's hard to get over that thought because, you know, for 6 hours straight, that's all I'm thinking. But But I had another thought too, and it was, wow, this smell is pungent. And that had nothing to do with my car, but there is a lot of pig manure that's getting spread right now. Now, I don't think it's any more or less than any normal year. I think it's just the weather just happens to be right for it right now and where we are in harvest. But this was a really big for that. And that, to me, was just making me think about input costs and, are we really pushing other alternatives in order to really, try to reduce our need for FERT at these higher prices? And I think that is the case as much as possible.
Well, we had a couple of questions about fertilizer. Do you see us, when you were here on the panel, we talked about higher fertilizer prices, high prices, cure high prices. How much higher are we going?
Yeah. I mean, a lot of it's tied into natural gas prices, and natural gas prices, at least for now, have subsided. Now, it is sort of consolidating here. It could break either way, higher or lower. I'm worried that it does go higher. I've got a lot of hedges in place for that for my farmer clients in order to protect against, higher natural gas prices causing higher input costs when we get into spring. But I do think there's a chance that prices are lower by that time. And the big test for that is going to be this second season Brazil corn crop. I don't think the market's paying enough attention to that. If the input crisis is a real deal, they're either going to plant less acres of corn or they're not going to put the inputs down and their yields will suffer. And if that happens, well, our domestic corn prices will likely go higher because we'll get more market share on the global export front. And it will also mean that, wow, we will realize this input cost thing is a big problem, so corn will really have to fight hard for acreage at that point.
Okay, I have an email question that ties in kind of where you're going, just to extend the conversation. Brad in North Dakota asked this question to us. Is inflation money coming into the grain markets now, and will it accelerate it more to the upside when the calendar turns over to 2022?
Yes, okay, great question, Brad. It had been, but it's slowed down quite a bit. You see where not your typical, commodity pool funds or what we call funds, right? But index funds. These are the ones that just, they use a basket of commodities really to protect against inflation. They're coming in at a fairly regular pace, so it's good to see. It's slowed down a little bit, but, there is that inflationary trade happening for the grains. But I think we've gotten a lot of that benefit already. You look at what's happening in the dollar wanting to break out to the upside. I don't necessarily agree with this, but a lot of people will say that that means that inflation is subsiding. It's still a factor. It's still going to keep us at elevated prices, but it isn't by itself going to give us a reason to rally into new highs. And I don't think that is the case unless we come out with a reason to think that inflation is going to go even more wild than it has. And I don't know what the Fed and also monetary policy, fiscal policy, I don't know what we can do to make that happen. We've thrown as much into the economy as I think is possible. We know that inflation is very real. The Fed has to be very careful at this point. Yeah.
Okay. Glenn in Ohio asked us a question a couple weeks ago that we used in the discussion, but he had another one. He was able to pause just long enough. I know harvest has been slow for him in a lot of areas. But Glenn asked us via Twitter, when was the last time the soybean corn ratio went to less than 2-to-1?
Right.
And are we going there?
Glenn. Hey, Glenn. Glenn's my buddy. I didn't need that. Yeah, I didn't. So 2008, 2011, 2012, it was below where we are now. Where we are now is a 2.24 corn to bean, right? So it is on the lower end of the spectrum. The spectrum usually is 2 to 3. 2 to 3 bushels of corn per every soybean would be an equal price, right? That's what that corn to bean ratio means. We're at the lower end of that spectrum, but we have gone below 2, or did he say 0.19?
He was just saying 2-to-1.
Yeah, so we've gone below that. That was in 2008, right? And we were dealing with a very similar situation where input costs were high. We were really trying to push as many acres because, corn and bean prices were good, but we were trying to push as many acres of corn. And yeah, corn was king. That was, I think, when we coined the phrase, corn is king. So it is possible, right? That 2.24 ratio that we have right now, it can move more in the favor of corn, and I think it is in the process of doing that right now.
Okay. Brian in Bald Bluff, Illinois, this is a China question. Given China seems to have as much influence as ever, does it make you a little antsy to be aggressive on new crop 22 sales for corn and soybeans? Or is this just post-trade war uncertainty something we're going to have to get comfortable being uncomfortable with? Is ANSI the new normal?
Is ANSI the new normal? I think ANSI is the new normal because, hey, listen, with the trade war, pandemic, whatever. I mean, it just seems like things keep coming out of left field on the daily. So, yes, ANSI is the new normal, but that's a separate question. With China, man, there's a lot to unpack here. I think China has designs on being very aggressive on the global front. They want to expand their empire. I don't think that they are done stockpiling the goods that they need before they feel comfortable in doing that.
You've been on that theory for a long time.
I know. I don't think they're done yet. Although recently, last week, they told their citizens, hey, you guys need to start stockpiling stuff in your own home. To me, that says they're getting close. So I think China is very much looking for some lower priced soybeans to come in and buy more. I think we'll be surprised at how much they do buy. But I think at some point, we're going to have to really worry about China a lot more than what we have. So, yeah, no, this is going to be a wild ride. I think agriculture is going to be a wild ride here for the next 5-6 years.
Pick Family Farms. We asked your question kind of when we get back to 13 at the beginning of this. But I got to give you a couple of yes or no's here just to kind of make sure I get everything. Gary, I'm going to save Gary's question for a moment. We'll finish with biofuels. But real quick, Sam in Eagleville, Tennessee asks, what's the cattle price going to do with $5.50 corn and $3.50 a ton soybean meal? We kind of rushed through it on the show.
Yeah. Look, Packers margins are good, right? So we're going to keep feeding. And I would like to see cattle prices, I'd like to see fed fats at, say, 144, 146. I just don't know if Packers will pay the cash up to the point where that would be allowed to happen. There seems to be a cap on this cattle market, okay? And we're getting towards the higher end of that range. I'd like to see what happens when we get to 140 or 139 if we do. Fundamentally, I can justify higher prices than that, but it just doesn't seem like the powers that be are allowing that. Let's say it that way.
All right, Mitch in Hull, Iowa, this is a pretty easy yes or no. What's the better bet on commercial storage, corn or soybeans?
I think corn. That's a tough call. Soybeans have the explosive upside potential, as per usual. And like we've said, I think, I have theories that China is going to buy more. If we get to 1080, China comes in and buys all the soybeans we have, and we'll end up at $16 again in June. That's a kind of a harebrained theory. I think I would feel more comfortable storing corn knowing that, if there's any problems with the South American crop, there's already input pressure. Corn prices are going to remain relatively strong. So that's my choice.
Tiffany, this is the last question. It is going to be Gary in Franksville, Wisconsin. He asks, will biofuels be able to pull markets higher, or will the strengthening dollar hold everything back?
Okay, two separate questions. I'm not going to go into the dollar. We've touched on that. Biofuels, yeah, I don't know if it pulls everything higher, but it certainly is going to help support things from going as low as they potentially could, right? Ethanol demand, really great. It's the shining spot on the corn balance sheet again. I love to see that. If we see some more exports come in, then we really have a ball game for corn prices to go higher. For soybeans, soybean oil, renewable biodiesel, renewable diesel. Yeah, I think that is a thing that is now similar to, when we started to proliferate ethanol. That, I think, elevates crush margins to the point where we can actually say that soybean oil rallies can be legitimate reasons for soybeans to rally. So these are very good things for the market, but it doesn't mean that we can't see a $1.20 drop in soybeans at some point just to go and find that demand. It just probably raises the floor, right?
Okay. Ted Seifried, thank you so much. Good to see you.
Always a pleasure, Paul. Great to see you too, buddy.
Thanks for the insight. And that will do it for Market Plus. Next week, we'll look at the rising cost of inputs. And Matthew Bennett will get all of my questions. Thank you so much for watching. Have a great week.